So what I'd like you to do for Wednesday is you're going to take this last page of the spending journal document. You're going to figure out your percentages and your categories. You're going to do a 1 to 2 paragraph reflection. You're going to take your budget that I'm handing back today. If you're not in class today, your budget will be in a folder outside of my office. And pick that up, make the shifts I asked you to make, use the lessons learned from your spending journal. You may adjust your budget, you may not. And then I want to see that first draft of your budget stapled to the final draft of your budget that I will grade, and then the 1 paragraph reflection. Okay? So that's one thing I want from you on Wednesday. Cool. Okay, second thing today, you guys are handing in your net worth statements, right? So for those of you that are listening to this and aren't here, you've got to get me a hard copy of your net worth statement today, or an email today, because they're due today, which is Monday. It's today, February 4th. Yep. And so for those of you that are here, please pass them down this way. Again, make sure your name's on the front. And I'll take that. Thank you. Next, we need to continue taking a look in Chapter 2 on present value, future value. And I had thought that I had assigned item number 8, but it sounds like I said that we ran out of time. So let's go ahead and work on that together. So for those of you that are listening, I'm going to use this little FlexPro guy, I hope, so that you can see the numbers that we're doing. And we are on page 79, and we're going to look at problem 8 together. So we're talking about this concept of present value and future value, right? Present value and future value. Present value is a concept where you know some amount out in the future. I want $1 million in 20 years to retire. Focus. It was focused, right? Well, that's not helpful. There, stay. So I'm not sure what to do about that. Let's see if we can go out here. There we go. Stay. Okay. So present value, right? I'm going out into the future, and I'm trying to pull some amount back and solve for today. What's the present value today? In other words, if I want $1 million in 20 years, how much do I have to put away today in one lump sum if I want to earn 8%? That's present value. That's discounting some amount out there back to today. Conversely, future value is I'm putting money away today. I'm putting 10 grand in the bank today, and I want to know what it's going to be at some point out in the future. And we talked on Wednesday about 2 things. I think we talked about a lump sum, and we talked about an annuity, right? What was a lump sum again? Yeah, it's just one chunk of money. My auntie died and left me money, and I'm going to take that money and put it away, and I want to know how much I'm going to have in 5 years, or 10 years, or 30 years. Versus an annuity, which is what? It's an equal periodic payment. So it's the same amount every year. I'm putting away $5,000 a year. Really, in reality, most of us put away money every month, but our tables in our book are built around annual, so that's what we're using. All right, let's go to the tables. We're going to take a quick peek back and make sure everybody's on the same page. 637, 638, 639, and 640. And we've already reviewed this, so I'm going to just quickly go over the headings. So if you turn to page 637, that is future value of a lump sum. It doesn't say lump sum anywhere there, it just says future value. So you should probably write in the words lump sum on the top of page 637. On 638, it's future value of an annuity. That's at equal periodic payment. 639, it's present value of a lump sum. Again, it doesn't say that, but you should write that in. And on 640, it's present value of an annuity. Now, so keep a sticky note there, or put your finger in there, or whatever. I'm going to write one more thing on the piece of paper, and then we're going to go through and work a couple of these problems together. So you need to get out a calculator, pencil, get your books open, all that good stuff. When you work these, the first thing you have to write down for every problem and ask yourself, what am I solving for? So the formula is present value or future value, you have to figure out which one it is, equals principal times a factor. And the factor is from the tables that we just looked at. That's some number that they're going to give you out of the book. And the principal is either that lump sum amount or the annuity, depending upon whether you're making the payment every single year or just once. And the present value or the future value is well, just what it says, what I just described. Are you looking at some amount out in the future, or are you looking at some amount in today's dollars? And you're not always going to be solving for present value or future value. Sometimes you're going to be solving for principal. You're going to know the PV or the FV, and you're going to be solving for principal. I'll get to you in just a sec, Casey. So here's your 3 questions you ask yourself every time. Number 1, is this a present value or a future value problem? Number 2, is it a lump sum or an annuity? And number 3, what am I solving for? Because obviously in an algebraic statement, we've got to know what 2 of the numbers are to solve for the x. Okay, Casey, question?
Yeah, so these tables are consistent throughout time?
Yes, they're just math.
It's math?
Yep,
Okay.
it's just math. Okay, let's look at the first one, and this is generally students' least favorite thing in the whole world to do, which is take word problems and translate them into algebra. But that's what we're doing in finance, is trying to figure out how to make sense of real life stuff. So in the first example, 8A on the bottom of 79, I am starting with $15,000. And I want to know how much I'm going to have in the bank in, what does it say, 10 years? If I earn 6% on my money, and then I want to know what I'm going to have in the bank if I earn 4% on my money. So let's walk through this together, and then we'll work it. Is this a present value or a future value problem? It's a future value. I want to know what I'm going to have down the road in 10 years. Is it a lump sum or an annuity? It's a lump sum. It's just one chunk of money. And what am I solving for? Am I solving for the present value, future value, or for the principal?
Future.
I'm solving for the future value. So now I can actually write the formula, can't I? Please write the formula. And then tell me what I'm going to have at 6% and tell me what I'm going to have at 4%. Does everybody have a book? It's 79. Everyone got a book? And if you don't, can you share with somebody or get near somebody that does? So you're going to give me two numbers. How much am I going to have if I earn 6%? How much am I going to have if I only earn 4%? Because you've done these, you can start working on number 9. Sure. Everybody know how to use the tables? Find the number of years and the percentage? So you've got to figure out which table you're going to, and we know this is a lump sum. And so basically you pull the percentage from here, and then the years are here. Yeah. So 10 years at 6%. Yeah. There you go. And then 10 years at 4%. Yeah. Yeah, there you go. Anybody else need help with the tables?
Where are the
677. Sorry.
637.
637, sorry.
I think I heard you right about your 6%.
Yep, you're going to go to the percent and then go down and this is your units. Yeah. Yep, you got it. Everybody find the factors? How you guys doing? And factors? So you're on the future value of a lump sum. So this is the 6%. And then the 4%. It's the same amount. But my factor is obviously, and I'm just rounding, how would this be pertinent to a real life decision? Why would I possibly want to take 4% if I could get 6? What's the relationship between increased return again? Risk. I mean, I could throw a 20% yield up there if I was willing to go into, Bitcoin or, something with a tremendous upside potential and a high amount of risk, right? So I'm looking at two fairly, 4% probably fairly low risk, 6 more moderate risk, and I'm saying, okay, am I willing to take additional risk to get another $4,600, right?
What would the risk be exactly? Would you end up?
It depends on the instrument. And it depends on whether it's a bond or a stock, and whether it's long-term or short-term, and whether it's global or local. And then you make all these assessments and you choose something. Like a couple of years ago, emerging markets were really hot, right? Brazil and India and China. And we got a new president, and we're in a trade war with China, and Brazil's economy has collapsed, and they've just, not collapsed, but Brazil's economy is fluctuating, and they have just elected really the Brazilian version of Donald Trump. I mean, there's lots of things going on that we didn't know in emerging markets 2.5 years ago. So your whole assessment of risk can be turned upside down by external variables, can't it? Okay. So, like, this is what you pay money managers to do. They can talk about the intricacies of the Brazilian, economy and help you make those decisions. Or plenty of people do the research themselves. I find it really daunting, personally. Okay, let's try number B. So does everybody agree that this is what's happening? Now, I want you to read B and write your formula. Somebody's lucky. They woke up and inherited $45,000. Okay, what's my factor? Well, first off, present value or future value? Future. Lump sum or annuity? Lump sum. Am I solving for PVFV or for principal? FV. So again, that's going to look a whole bunch like this one. I'm trying to find my future value. I know my principal. I go to the table and I find my factor is 5.427. So, gosh, at 45 grand in 25 years is going to be almost $250,000. Wow.
So would there be a difference between like if you're best and something, or is this the same question the guy had over there? Like if you invest in different like stocks?
Certainly. These are just mythical numbers we're doing for academic purposes. In the real world, you're going to be using something that's a composite of all the different things you're invested in. Okay, D. Let's try D. Let's skip ahead over C. And now D is two parts. Let's look at the first one. You think in 15 years it's going to cost you $212,000 to send your 4-year-old kid to college? Probably not an unfair assessment. In 15, you've got a 4-year-old kiddo. In 15 years, you think it's going to cost $212,000 to send him to college. You've got 70 grand a day. This is real life stuff. If you invest that in something that pays 5%, are you going to have the money to get him there? So figure that out first. You're going to have the money to get him there with your 70 grand a day? $70,000. Nope, I'm going to be shy. So, I'm going to be about $67,000 shy. So the question in the second part says, if you start from scratch, so you're gonna take your 70 grand and do something else with it. Put it in your retirement. So now the magic question, which is how most of us save for really big things like kids' college, isn't a chunk of money, it's doing what? Putting away money every year, right? Actually, usually for most of us, every month. So the question now becomes, how do I get to the $212,000 if I'm putting money away every year for 15 years? Is that a present value or a future value? So I know the future amount. I know the 212. What I don't know is how much I need to put away every year. Try this one. And this one is not as easy because we're talking about an annuity, not a lump sum. And when you write your algebraic formula, you're going to quickly see it's not a multiplication problem. So do just like what we did here. Write your formula out. Get your lump sum or your annuity and figure out what am I solving for in this case. So, I know my future value. I don't know what my lump sum or my annuity is. That's what I'm solving for. And my factor, so what am I using? 4%, 15 years. Present value of or future value of an annuity factor. Did you get 20.024? Then obviously, if you're going to solve for that, you've got to divide both sides of the equation by the 20.024 to solve for the x. Do you have a question?
Yeah, where are you getting the 20.024?
I got that from the future value of an annuity table, and it was 4% over 15 years.
Thank you.
Sure. You can also work this with the present value tables. Mathematically, you're going to get the same answer. I find students do better with the concept of being provided with a future value, bringing it back. But mathematically, you can use either. You're just solving for different parts of the equation. How much does he have to put away a month then? And this isn't going to be exactly right because your interest is going to be compounding monthly, but roughly help my guy understand how he's going to get to $212,000 for his 4-year-old son. How much is he going to have to put away a month roughly? Okay, still not a small number, obviously, but a hell of a lot more manageable than looking at the ginormous number of $212,000, right? I think he needs to put away about $882 a month. And it'll actually be something less than that because interest is going to be compounding more rapidly. But it gives you a ballpark, doesn't it? So all of a sudden it's manageable. Or you say, God, there's no way I'm ever going to do that. I've got 3 kids. I'm going to put away $250 a month per kid. Then can you figure out how much you're going to have when you get there? Yay or nay? Okay, tell me. God, there's no way I can do this. That's never going to happen. How much?
Well,
Yes. Yep, yep. Same interest rate. What are we using here, 4%? How much am I gonna have? If I do $250 a month, you're gonna have to just convert that to annual. And again, this isn't completely accurate, but it's ballpark. If all I can do is $250 a month, at 4% for 15 years, how close am I gonna get to my 212? $250 a month, and again, you know, this isn't completely accurate, but I'm gonna be putting away $3,000 a year. Let's see, where am I at? 15 years, 4%, 20.024. $3,000 times 20.024. Right? So is this helpful for planning? Obviously. Wow. Here's what I'm going to be able to do for you, kiddo. I'm going to have 60 grand saved. You're going to need to work and probably make 10, 12 grand a year, and you're probably going to need to borrow 10 or 12 grand a year. And now everybody's on the same page. Right? See how helpful this is? This is how you plan for retirement. This is how you plan for saving for a house. This is how you decide whether you're going to take that additional risk or not. I could convert this $3 grand a year into $212,000 if I was invested in something that paid 25%, right? But if you knew how to get 25% a year guaranteed for 20 years, you wouldn't be sitting here crunching these numbers. You would be a billionaire because you'd be turning cash into gold. Okay. Do you understand how these work? So here's your steps again. So for Wednesday, so here's your steps. Writing out your formula every time. Number 9 through 11 are due on Wednesday. Hard copy, please. And do all your work just like I did here. Try and stay methodical. Write the formula. What am I solving for? Don't just do it. Students have a tendency, because you've been raised so digitized, to just do everything on the small little piece of equipment. And then if you don't have the right answer, you can't go back and track what you did. So I really prefer that you write the formulas out. Okay? Yay. Okay, that's essentially a wrap for Chapter 2. I'm going to pick up your spending journal with your redone budgets. I'll have your comments on your net worth statement back to you. I'm going to pick up assignment or numbers 9, 10, and 11. This is quite a bit of work. You're going to want to give a couple hours of time to this probably between now and Wednesday. And we're going to start on Chapter 3. The other thing that we did in Chapter 2 that I don't have another reinforcing because we've done 2 is reading paychecks. So those were the big takeaways from Chapter 2. I am going to test over Chapters 1, 2, and 3. So we're sort of honing in on test day, which is a week from Wednesday, the 13th. Chapters 1, 2, and 3 I'll test next Wednesday. And that following Monday, the 18th, I don't see you. That's President's Day. The 13th is the exam, and then that next Monday, the 18th, we don't have class. So we're going to spend half of today, or a little bit more than half of today, on Chapter 3. And then, of course, we'll work on that all day this Wednesday and all day this Monday. I'm doing any review that you might need. Okay, so I'm going to hand out a packet for those of you that are listening online. You can pick one of these packets up outside of my office along with your budget. And we're going to explore the wide world of taxation in Chapter 3. We have a really radical piece of tax legislation reform that was signed in to a bill on December 17th, 2017. So honestly, I'm getting used to all this. I've been in I've had a private tax practice for 25 years, and this is the most radical shift in like what everything looks like in my entire time practicing. So I'm going to be bumbling around a little bit. This isn't going to look at all like what's in your book. Your book's got 2015 tax numbers, tax formulas, tax rate schedules, tax returns. Okay, I didn't think it was very helpful at all to study what it looked like in 2015 when it doesn't look like that at all anymore. Okay, so we're going to be using current information. What I am going to do is, that is going to be a little bit of a challenge, is using our book, but having to moderate it based upon what I just told you, that the numbers are all different. So the first thing I want to do is turn to page 91 and look at something called a tax formula. Super exciting. First question, how many of you do your own tax returns? 2, 3, 4, 5, 6, oh, half of you. Oh, great, okay. Fair enough, great. So you have looked at a tax return. You have some idea what tax rate schedules look like. Yeah? Awesome. Okay. This is basically the formula. Now let's just walk through this. If you've got your book open and you don't mind writing in your book, you might take notes, or you can just do it, whatever. But let's go and talk about some of these different areas, and then I'm going to tie this tax formula into the actual tax return and help you kind of see where the lines are. So the first thing, and I mean I teach a 15-week class on this, so this is going to be like a really synthesized version of taxes. The first thing is basically tax code says that everything that you earn is subject to tax. That's that first little thing up there, gross income. All income is subject to income taxes unless it's specifically exempted. So what that means is tax law says every single penny that comes into your checking account, essentially, everything that you earn is all subject to income tax, except for if we specifically, i.e. Congress, excluded it. So for example, if you get Section 8 housing vouchers, or you get SNAP, food stamps, I guess was the old term, they're cards now, that's specifically excluded. You don't pay tax on that. If you get, in Montana, your unemployment checks are specifically excluded. So if there's something in the code that says you don't have to pay tax on it, then you don't have to pay tax on it. But otherwise, everything else, because people always say like, oh, I rented out my back 40 to the guy next door, his horses graze on it, is that taxable? And my answer is, yeah, unless there's a specific exclusion, and I know there's not. So yeah, it's taxable. I sell, Arbonne on the side, and I made $800 last year selling Arbonne. Is that taxable? But yeah, there's no specific exclusion for selling makeup and personal hair care products. So yeah, it's taxable, right? So that's basic number one. Gross income, all your income is subject to income taxes.
What about donations?
Gifts are specifically excluded.
Like what donation?
I would have to look that up. I don't know of an exclusion for plasma or blood donations. if, you don't have to answer this because it's private, but I think when you go to give blood or plasma, that you have to actually obviously show an ID, and they're gonna pull social security number. That's in order, whenever you have to do that, that's in order to issue you some sort of traceable statement. Do they not require that?
I've been doing that for 40 years. There's no tax deduction.
Not tax deduction, is it taxable income is the question.
Oh, taxable income.
Is it taxable income? And I don't know the specific exclusion for it.
I don't know.
My guess is it would be.
I always assumed that they never mentioned anything about it being taxable.
And you haven't provided a social security number?
I always can't remember when I signed up if I did that or not.
Yeah, because those are the kinds of things that oftentimes will surprise people. It's like, yeah, they didn't really say anything about it, and then you go to this time of year, you go to your mailbox and you pull out a 1099, and it's like, oh crap. For most of you in here, your gross income is going to come from, your taxable gross income is going to come from a form that you get from your employers called a what? A W-2, and we're going to be working with that. If you've got a little side business, that's called self-employed income. And you have to pay income taxes on that. And you also have to pay what that we've studied, besides income tax. Yeah, both shares of the Social Security, right? So, let's see. So for most of you, this is going to be W-2s. Okay. But you may also have something called self-employment income, SE income. So I paint, or I drywall, or I shoe horses, or I ski coach, or any of those myriad of things that you might do on the side to make some money, but you're not actually employed by the person. What do you get as a form or a document if you do that at the end of the year? Anybody know what that's called? It's not a W-2. That's a 1099. 1099 miscellaneous. Okay, then we're on step A. We're trying to figure out, and I'll call this AGI, your adjusted gross income. In tax lingo, we just call it AGI. So you start with all the things that are taxable. If you get unemployment, that's in here. That's in your gross income. If you get pension distribution. All right, so I've been saving my whole life, and now I'm retired and I'm taking out $1,000 a month. That's all part of gross income. Then there's these very specific things, and there's not many of them, that Congress specifically allows all of us to deduct. And I'm going to read some of these things. And it's not important to me that you know this whole list, but let me just put this up so you get a feel for some of them. These are the lines I'm talking about, 23 through 36. Educator expenses. If you teach K through 12, you get to write off $250 a year of supplies. Recognizing that pretty much everybody that teaches spends money out of his or her own pocket. So if you teach K through 12, you get up to $250. Line 25, health savings accounts. What's a health savings account? Go ahead. It's an HSA, and they work. You guys, an HSA works just like an IRA. So what I do is I put money into it every paycheck, and then when I have out-of-pocket medical expenses, guess what I can do? I can go grab it out tax-free. So I get a write-off on my tax return for it. These are all negative numbers. and you're not going to be required to know all these, but I'm just trying to give you an idea. Anything that you see here, it's because Congress has really thought that it was important for everybody to have the ability to write these kinds of things off. Health savings accounts are for people that have high deductible health insurance programs or plans. And I would tell you probably 80% of my clients have them and use an HSA. Because like our personal insurance policy, we're $3,000 out of pocket every year for the first $3,000 of expenses. So my husband has to go in for an MRI. I don't have $3,000 sitting in my account. What do I do? Put $150 a month in an HSA, and then I can go pull that out to use for my copay. Okay? I can almost guarantee every single one of you in the current environment with health insurance will have an HSA at some point. Because most of us can't afford the out-of-pockets all in one chunk.
So this is the one above reward, but some benefit doses. So what would that include? Like
This is
really broad.
no, it's not. It's only for people that are performing artists in the Army Reserve or the National Guard, and fee-based government officials. We used to all be able to take employee expenses, and now it's only those 3 categories. Super specific. So I'm only covering the ones that are pretty, like, maybe applicable to you. So if you're going to be an educator, here. Health savings accounts, here. If you're self-employed, and you pay your own health insurance, you get to write that off here. If you've got a job and you pay your own health insurance, that doesn't go here.
Does that include money paid into the ACA if you're under Obamacare?
Oh, sure.
So any premiums, including what they adjust for, because they adjust what they do.
After the adjustment for the advanced premium, or the advanced premium credit. Yep. Alimony. IRA deduction. And then what would obviously probably be most pertinent to most of you, line 33, student loan interest. So if you've got student loans and you go off of, what's that called, deferment the 6 months after, you will start getting a statement every year that tells you how much your student loan interest was. And you get to subtract that from your gross income. Yes, ma'am? Alimony is if you're divorced and you're court ordered to pay your ex-spouse X dollars per month. Child support's not deductible. Alimony is. Okay, so we just looked at all these items, and that is this, adjustments to gross income. So gross income minus all those adjustments takes us to AGI. AGI is on the second page of the packet I gave you, right here. And the total of all those adjustments that we just looked at go right here. And that's important because we're going to do a tax return in a couple seconds here. And again, like I said, this is all new to me. This is not at all what it's ever looked like my entire life. This is all new. I hate it. Oh, shoot. Thank you. Went back to blurry. I think that when I get my hand under there, it starts to read that. But then what's confusing is sometimes when my hand isn't there at all, it starts shifting. So I don't know what that's all about. Okay. The next 2 items, so we're in your book. If you've got your book open and you don't mind writing in it, cross this out. Personal exemptions are gone. Doesn't exist anymore.
As of last year.
as of, so on 12/17/17, Congress and the President signed into law called something called the TCJA, which I'm sure you've heard about as the big tax cut bill. Tax Cut and Jobs Act. And it did cut taxes. Permanently for corporations, temporarily for individuals. It sunsets at the end of the president's term. So the individual tax cuts are impermanent. The corporate tax cuts are permanent. So take what you may from that. Personal deductions are gone. We're right here now. We're trying now to go from AGI to TI. TI is the number you calculate your tax on. Taxable income, or TI, is the number we're going to take to some rates to determine your taxes. Okay, and then you're going to compare that to how much you paid in during the year and hopefully get a refund, but maybe owe money. So the only thing we still need to take a look at to figure out how to get down to TI, it says the larger of itemized deductions or standard deduction. That is an amount that the government just gives you per year. If you're single, it's $12,000. If you're head of household, in other words, you've got a dependent child in your house, so this is like for a single parent essentially, but there's other examples, but roughly, head of household, you get $18,000 for your standard deduction. And if you're married and file a joint tax return, married filing jointly, you get $24,000 a year. So what does this mean for you if you get a W-2 for $8,000 a year?
If you're poor, you don't have to pay as much taxes?
You don't have to pay any taxes. If you get a W-2 for $8,000 a year, you don't have an income tax situation at all because you're under the standard deduction for single. If you're married and you support the family and your husband's in school and you made $22,000, do you have an income tax situation at all? Nope, because your standard deduction cancels it out. Those numbers doubled under the Tax Cut and Jobs Act. Impermanently for 4 years. They sunset in 2022, I think.
And they'll go back to this.
Who knows?
So currently 12,000, like
Yes.
24,000.
12,000 if you're single, 24 if you're married filing joint.
So if we go back to like 6.
It was, yeah. I mean, who knows? Yeah. And anything could happen. Okay, and the personal exemptions are gone. So now I'm down to taxable income. For our purposes in here, we're not going to study what itemized deductions are. I'm just going to give you a snapshot. Because if my itemized deductions are bigger than those numbers, I get to use that. And itemized deductions are things like charitable contributions, real estate taxes, mortgage interest, medical bills if they're really big. So I have plenty of clients that have itemized deductions, but most of you in here have itemized deductions. You're going to have standard deductions.
Can you show us where that would be on the tax form?
Yes, thank you. I can, I think. Right here. We are looking at line 8. Standard deduction or itemized deductions, and then it has all those numbers I wrote in a little box over on the left. If you're single or married filing separately, it's $12,000. If you're married filing jointly or a qualifying widow or widower, it's $24,000. If you're head of household, it's $18,000. And if you itemize deductions, you have to fill out a whole nother thing called a Schedule A. But you would only do that if the number from a Schedule A is bigger than this 12 or 18 or 24,000. Okay? And I can guarantee you the only way anybody ever gets to a Schedule A is if they own a home and have mortgage interest. I've never seen anybody ever get bigger than a standard deduction if they don't have mortgage interest in there. Okay. Do you want to ask me any questions so far?
What are some more examples of itemized deductions?
So itemized deductions are your medical expenses. And that includes dental and eye and surgery and mental health care and really everything except for over the counter. Your charity, cash and non-cash. If you've ever given stuff away at Goodwill and they're like, do you want a receipt? They give you a blank receipt and you just go fill it out. Any cash you give away. It's your real estate taxes. It's your license plates on your car.
So if you give just like your very, very low, you give like $100,000 to charity, that's all, you just write that off your X number of dollars,
Yeah.
and give back to the government.
It reduces your taxable income.
Got it.
So
The difference between like different like, tax brackets.
it absolutely could, and I calculate that for people all the time. People will come in and say, I'm trying to decide whether to give away 20 grand or 30 grand this year. What's the tax ramifications? And basically, what I, because I'm philanthropically minded, I want to help make a case for them to give away the larger amount.
Yeah, 'cause different tax brackets.
Sure. Absolutely. So we do a lot of calculations around that. What was your question? Oh, what else is deductible?
Yeah, just examples.
Yeah. Medical, charity, real estate taxes, and mortgage interest. Interest that you pay on the principal on your home, on your note. But not interest on things like credit cards or car loans, personal stuff. Only really your house.
Hey, you said if you give something to charity, what do you need from them?
A receipt.
And if you own multiple homes,
You can have up to 2 primary residences.
and if you're filing with, say, your significant other, then that would, both of you would only have 2 total, or?
Two total. 2 total. In Missoula, I don't have a whole bunch of people that own more than 2 homes. Or, I take that back, I have a lot of people that have rentals. But your rentals aren't part of your itemized deductions. That's a whole other schedule that you've got to show how much rental revenue did you get minus all your expenses for your rental. And that number goes into your gross income.
Now, I know someone who is a snowbird and spends half a year someplace
Yeah.
in one state and half a year in a different
Sure.
state. Now, would that affect the,
So we're looking at a federal tax return. You also have to file a state tax return, okay? And in Montana, you claim full year residency in Montana if it's your permanent home. So even say I go to Arizona for 6 months a year, I'm still going to file and pay income taxes in Montana. Did that
What if
answer
you
your
pay
question?
those in another state for your primary?
I'm going to file a Montana tax return. I've got one guy, he goes up and he works crabbing up in Alaska every year and makes shit ton of cash up there. Well, but he's a Montana resident, so he's got to pay a chunk of his 30 grand to Montana. He's a Montana resident. I have a pharmacist that travels all over the country. She works, what's that called? One more time? It doesn't matter, but I mean, she gets called like, come to Atlanta for 2 months, and come to Birmingham for 2 months, and Miami's short on a pharmacist in there, so she travels and works.
What if you own a different home in a different state?
Then you've got the question, if you own a different home in a different state, you really have to identify where your tax home is. And there's a laundry list of things that you have to answer or tell me about, and it helps me determine where your tax home is.
Okay. Let's say you primarily live in Montana, but you own a home in Washington, but you get more tax benefits in Washington. Can you do that?
So there's no state income tax in Washington. So I would want to, so if all I'm doing is buying a house there, to get out from underneath paying Montana state income taxes, that's not gonna work. If it's if my home in Washington is primarily where I work, where my children go to school, where I maybe have my business registered, then my tax home is in Washington. But if I just bought a house over there and I pop over there a couple weekends in the summer, but I work here, my kids go to school here, I vote
So
here,
you guys determine that then, you yourself?
I will help somebody determine it based on the facts, and then I'll take it to the Internal Revenue Code and go through that laundry list of questions I just asked you. And that's kind of what you pay me for, is to give you advice.
So just say you make 10 mil and you invest up to 8
Just
mil,
say.
8 mil is like for one property,
Uh-huh.
like real estate and stuff like that. What does the United States government tax you at?
You are taxed as a United States citizen on everything that you make everywhere in the country. With that, or in the world, excuse me. With that said, I've got a client who does reproductive rights work for women in Senegal, and she's lived in West Africa for 3 years. She has not given up her United States residency. So the way that works, of her income in Senegal, and she makes a lot of money, the first $3,000 a year, it's called a foreign earned income credit, and that is not taxed.
But
When you start getting into things like investing in real property and investing in offshore subsidiaries, that is way past my scope. I would never handle a tax, and I would never handle a tax return for somebody that had an 8-figure net worth. But that's not completely true. If your income was at that level, that's so out of my league, I would never touch it. Because I don't have malpractice insurance, because I practice by myself. You would go to somebody that specializes in that.
So if income isn't taxed because it's foreign, is it taxed anywhere else?
Only the first $102,000. Now, if she was taxed in Senegal on her Senegalese income, that's a different calculation. She would get credit in the United States for the part of the tax she paid to the Senegalese government.
Is there a scenario where you wouldn't pay taxes in 2 states, like for example, if you had 2 properties and rented it out for the years and that, but there is a way you would
Absolutely.
end up having.
Absolutely. I've got a gal right now who she and her husband have very normal jobs in Missoula, and her family has a huge liquor distributorship in Ohio, and she gets a ginormous chunk of change on a monthly basis from this distributorship. So we have to file an Ohio non-resident tax return so that she can pay Ohio the chunk of the money she's pulling out of their economy and putting into ours. Gosh, you guys have really good questions. I was really trying to keep this super duper simple. Okay, so taxable income, now we have to figure out what the tax is, and then you're going to compare that to how much you paid in or didn't. And you get a refund, or you got to write the government a check. Okay? So your next question is going to be, tell me what the tax rates are. And I loaded that on your PowerPoint. I hope this is here. Did I not have up the, oh, it's right here. Silly. Okay. So I loaded the new tax rates. Again, the ones in your book are not correct. They are from 2015. And so in the PowerPoints for Chapter 3, entitled Preparing Your Taxes, we're going to look at the tax rates. And then we're going to hopefully work through a W-2 from my buddy Elmer Berry that's posted. It's what?
5.
Oh, thank you. There we go. Okay, now this is the part where you really need to tap in. This is called a progressive tax rate schedule, which means that the more your taxable income, the higher your rate. Make sense? So if your taxable income is less than $9,525 a year, this number right here, your tax rate is 10%. But if you go over that amount, say your taxable income is $20,000, then is all of your income taxed at 12%? No, just the amount over the 9526. So what I'm telling you is that if I file a tax return and I made $10 million last year in taxable income, I still paid the same 10% on the first $9,525 that you did as a student. So people have a tendency to think, oh, like I made $1 million last year. Oh, I paid the 37% on the whole million. No, I didn't. I went up the stepping stones just like everybody else. Does that make sense?
So like contributing to charity would potentially lower you from the 35?
Yes, exactly. I've got $200,000 of $220,000 of taxable income. This was your question too. I have $220,000 of taxable income. You can see that that last 20 grand of income was taxed at 25%. But if I can get my TI down below 200,000, I'm back in this bracket for those dollars. So I can start doing calculations about, hey, are you philanthropic? How much do you want to give away? Well, let's talk about that, what that's going to do to your tax rate for your highest marginal tax bracket. All right, so do this for me. Calculate the tax bill for somebody that has TI of $186,000. And you can do the whole stepping stone approach, or you can just take the easy peasy and just do the math they tell us to. What was that number? What did I just say? 180? Line 10, taxable income equals $180,000. And just don't put any pennies, just round everything to dollars. 32% of the amount over 157.5. I'm not going to give you the answer. I'm going to ask you one more question to finish this example up, because I do want to just take a quick peek at this W-2. If the person in question here, if this is a job, so she's not self-employed, she gets a W-2, how do most of us pay our taxes, and do we do it in one lump sum at the end of the year? Most of us pay with our paychecks. Remember, we've been looking at those pay stubs? What if this person paid in $45,000 in income tax last year? Is she getting a refund, or does she owe money? And if so, how much? She paid in $45,000 with her paychecks, with her pay stubs. How much is she going to get back? Or is she going to have to write a check? I think that her tax is $39,290. Did you guys get that? And I just did the formula here right off that slide. 32,090 plus 32% of the excess over 157.5. And if she paid in line 16, federal income tax withheld from forms W-2 and 1099. If she paid in $45,000, she's getting back $5,710 refund on line 20A. What'd she get back? $5,710.
It's more common to write a check or to
It's all over the place. Without getting too far in depth, that $45,000 she had withheld from her paychecks, and let's make this more meaningful to numbers that make sense to us. You have a job, you make 20 grand a year, your standard deduction's 12,000, your taxable income's 8,000. Your tax rate is 10% based on that schedule I just had up, so your tax bill is $800. I'm going to compare that to how much you had taken out of your W-2, right? Or is every single one of you, if you make $20,000, you're going to have the same amount taken out of your paychecks? No, why not? It's how you fill out that very first form the day you go to work called a what? A W-4. Did you put 0 or 1 or 2 for your exemptions? The lower the number, the higher amount of tax they take out. So you might all have $8,000 of taxable income and be single, and you might get a refund, and you might get a refund, and you might owe a bunch, and you might get a refund, and you might owe a bunch, based upon how much was taken out of your paychecks during the year. Does that make sense? Okay. Last thing we're going to do today is take us just a quick look at this W-2. Where do I have that? Did I give you a W-2? Oh, I did. All right, so let's... So here's my client, Indigo Smith. She lives in Choteau, Montana. She must do some sort of digital work for IBM. How much did she make last year in gross wages? Yeah, $87,980. Is that her taxable income? No, because we know there's other things, right? It looks like she's got some what down here at the bottom? Student loan interest. It looks like she had some federal income tax withheld from her paycheck, right? How much? $64.15. Could you guys do a quick calculation for me, please, and verify the Social Security is correct, that they took the correct amount? You know what the percentages are for Social Security and for HI. Does anybody need a reminder? Anybody want to offer it? That's between them. Social Security is what? 6.2. And HI is 1.45. So verify those numbers. Make sure those look correct. I feel like it looks like the HI's off a couple cents, isn't it? Yep. I think that the HI's off by like a dime.
A whole decimal place.
I got that too.
87.
It should definitely be more than 100.
Oh my gosh. What do I do now? You have to go back to your employer and get issued a W-2C, a corrected W-2. What's my point of illustrating this? How many of you check your W-2s?
Just got them now.
Human beings prepare these. I've seen hundreds of errors over the year, less so now that they come out of software. But if you get, garbage in, garbage out, right? That HI was misheld by a decimal point. It's supposed to be $1,274. And you know what? If that's all they took out of your check all year, guess what you owe? Cash money today. The difference. How would you have caught that?
What if they messed up, misreading your W-4?
Here's this thing, you guys. The reason I taught you how to read a pay stub is if somebody's screwing up your pay stubs and you don't catch it and you get to the end of the year, I was like, oh, we only took $127 out of your checks, but you really should have had $1,274 taken out. That sucks for you because you need to write a check for that $980. Or my W-4, I said I had 4 kids, I said I had, but it doesn't matter, whichever way, and they take out way too little. Bummer, you still owe the money at the end of the year.
Well, wouldn't it be their fault even if you gave them the right
You
information?
did, absolutely. That sucks. Their payroll clerk is probably could lose her job, but that is not going to help you when you have to write out a check for $2,000. It's up to you to read your pay stubs, read your W-2s, check your tax returns. I've had 1,000 people come to me over the years, oh, H&R Block did my taxes. And I'm like, yeah, well, they're wrong. They're like, well, can I go back and sue them? It's like, yeah, no. You signed your tax return, you need to read it and agree with what's on it.
So in this situation, since they're off by decimal points, you have to just write a check.
I'm hoping the software is screwed up. But I'm going to go to my last page stub and see. Okay, you guys are like, okay, it's time. Enough tax fun. So Wednesday, we're gonna go over the present value, future value, number 9, 10, and 11. You're gonna have your spending journal, categorized, reflection, and your budget updated. I'm not going to input a grade for your budget until I get it back with the things I just mentioned. Okay? Try and stay warm. It's so brutal.
The budget, the cash flow,
No, the net worth I got today. The cash flow, your hand. The cash flow budgets came around in a folder. Where's the folder?
Oh, that's what that was.
Thank you. Do I have all the net worth? Okay, for those of you that are listening to this online, you can get the tax packet and pick up your budget outside of my office.